how many people will turn out tonight, but we'll see. It's Friday night, so we're starting a little bit early here as well. And so, really, I think this will be useful for people that are watching the replay as well. Never done one of these on Friday nights, so hopefully if you guys are turning up and watching this, it'll be pretty good. If not, this is going to be up on Facebook and my YouTube channel for a fairly long time, but I see people starting to come in now, which is awesome. So, hey guys, say hello in the comments. If you're on Facebook, come over to my YouTube channel, because stupidly, Facebook doesn't allow for these comments basically to show us who you are. So it's always good to know who you are, like who you actually are, because we know most of the people in the Facebook group and stuff, but it comes up as anonymous, which is really annoying. So if you come over to the YouTube channel, it's probably the easiest thing to do. Anyway, tonight I'm talking with Stephen from Synthetic Yields, which is really cool. We did one of these probably 3 months ago now, I think it was.
Yep.
Yeah, It's like 3 months ago. So
yeah, it was in November, I think.
Yeah. And so things have changed a bit. The market is starting to turn, which is one of the really important things I think I'm pretty excited about today, is that you can see on the screen at the moment, we've had this, well, hopefully, fingers crossed, is a reversal in the markets, right? So we're hoping to see that this downtrending resistance line has been broken properly for the first time in, a year? I mean, it's been ridiculous. We've been going down, basically getting rejected from this downtrend. Okay, we had a little bit over on the right here where we did start to break through it, but now we're starting to look a lot more positive to me. Is that kind of your thoughts, Stephen, or what's your kind of thoughts here?
Yeah, exactly. I mean, it's it's crossed that trend line, and so that makes it more promising than the past, bear market rallies that were fake outs, right? And I guess the fact that if you see on your chart there, right, it made a higher low recently, right? Exactly. And before it was always a lower low. So it's promising.
Yeah, I'm excited. I think this strategy that you're going to talk about tonight, it works in all markets. Like, you killed it in 2022 compared to the market. But when this market is going back up in a bullish type of market, I think your strategy is going to just totally excel. And I think you agree, right? We've talked about this a little bit.
Yeah, no, I think in a flat or up market, do even better than last year. So
and you beat the market. You beat the bear market, which is awesome. And I think once you've lived through something like 2022, like if your strategy holds up in 2022 and then 2023 is better, you're gonna it's gonna be a whole new world of awesome returns. So I'm pretty excited to see where your Oris strategy goes, and I think it's going to be a year to remember. I think if you look at the historical data, and maybe I'm wrong here, but you can correct me. I know you look at this stuff a lot more than I do, but it tends to be that the year after is usually a good year, right? After a bear kind of run. So I think
there's only been 3 instances since the 1920s or 1930s where you've had back-to-back down years.
Yeah.
And 2 of those 3 instances were, so if you remember, I think it was 2000, 2001, 2002, I think, were all down. Right. So you had 2 of those back-to-backs right there in the early 2000s. The other one, I think, was in the 1930s. So it's rare that we ever have back-to-back down years.
Yeah. And so I'm pretty excited about it. I think who knows what will happen. We don't have crystal balls, but any of these strategies, especially the Aura strategy, is going to pay off much more, right, in these up markets, because you're buying these leaps, and then the hope is that those things don't go underwater at all, and you end up making money both from the income rental part of it and the underlying asset, which is going to be the key here. And that's why I'm so excited to try out your strategy in the coming year. So I guess you have some slides prepared, or we can talk about that, and then
Do I steal the screen here, or do I?
Yeah, so if you can share your screen, I'll take away my charts here from the SPY.
Sure.
So if you hit the present button down the bottom, it should say present, and then it'll pop up, and I'll add it to the thing and take away mine.
Okay. I see here.
And so, guys, this is a really interesting strategy. It's one of the things that most people, I see your thing pop up, it's one of the things that a lot of people don't really focus on that much. And I think you do a really good job, Stephen, of presenting this, and the idea of comparing it to other financial ways of making passive income.
Yeah.
So
Yeah.
I'm excited to go through this again with you, and then I think you're going to talk a little bit about your spread stuff as well, right?
Right, yeah, and they kind of go hand in hand together. So I'll explain that. Another fun fact, though, first, we were talking about different interesting stats in the market. The third year of a presidential term also is the most bullish of the, if you're kind of thinking about markets in 4-year cycles with the presidential term, the third year of a president's term has historically been the most bullish, and it's rarely been negative, and it's usually up by a lot compared to the average. So just we have that nice thing going for us in 2023.
Right, that's cool to know.
Yeah.
So
So let me get into the
yeah,
presentation. I know some of you probably have tuned into the last one, so some of this might be covering old ground. But for those of you who don't know me or did not watch the last webinar, I'm Steve. I've been following and trading the market since the early 2000s, so over 20 years. I do remember the .com bust. I didn't have much money in the market at that point as a teenager, but I did lose a lot in that .com bust. It wasn't fun. So just a little disclaimer for any presentation I do, right? So just put that out there. So I kind of usually start by asking these questions because I think for a lot of us, at least those who follow Russell and are tuning into this webinar, you probably have these same questions. And so these were kind of questions that I had answered yes to. And I was looking for a good side hustle. I've always been interested in the markets, but I've kind of tried to package what I knew about the markets and investing in options. And over time developed what I'm going to talk about today, which is the option rental income system. And I like to compare it to, in my mind, at least, I like to compare it to doing Airbnb or Turo, right? So for those of you who are familiar, I think everybody's familiar with Airbnb. Turo might not be as familiar with some people, but it's becoming more popular. It's essentially you can rent your car out to strangers on that platform on a daily basis and collect rents from your vehicle, right? So some people have made it into a business where they own a fleet of 10, 20 cars, rent them out on Turo. So it's become a big business. And I was thinking you can kind of do the same thing with options. So if you answered yes, then you may be interested in ORIS, which is the option rental income system that I'm about to talk about. So what is ORIS? ORIS, I already told you, is the acronym for Option Rental Income System. I just thought it sounded cool to say ORIS and to try and coin that term. I don't know if it's picking up steam, but I just use it as shorthand to refer to this strategy. But it's essentially a poor man's covered call with a set of rules. And go ahead, Russell, if you have any comments or if there are any questions, feel free to stop me at any time.
Yeah, no problem. I'll keep an eye on the comments and bring them to your attention as we go. I'm just trying to send out messages at the moment to get people to come. Okay. So just keep going. Yeah. I'll interrupt you.
No worries. And if people aren't on live, they can watch the recording.
Right.
So the basics of ORIS, as I mentioned, poor man's covered call. I think a lot of you out there are familiar with options and know what that is, or at the very least, you know what a covered call is. But with a poor man's covered call, sometimes also called a diagonal spread, you're going to buy a longer duration call option. And in this particular strategy, I buy a deep in the money 365 plus DTE, meaning more than 365 days to expiration call option. And then I'm selling a shorter duration, typically 30 days to expiration at the money call. At the money, meaning, the stock price is trading at $50 at the time, then I would sell a $50 strike call.
Cool.
And so this allows us to essentially collect rents on stocks, if you think about it. So what you're doing is you're owning an asset, whether it's shares or In my case, with this strategy, it's a leaps call, far out, deep in the money leaps call. And we are essentially renting out our upside by selling a shorter duration call. So whether it's for 30 days, 14 days, for that period of time, we're renting our upside out to the person who bought that call from us, right? I like to think of I'm selling hope and dreams to speculators like that are buying that call, hoping that it will go up enough for them to break a profit, right? And you can do this on almost any stock, right? As long as the stock trades options. Now you do kind of want to find stocks with liquid options. So you're generally looking at larger companies. So we've got some logos on the side of companies that you would know. And these are all companies, except for Starbucks. I don't know if I've ever done this on Starbucks. I've looked at that. But every one of those other companies I have done this with in the last year, I would say. So that's one type of trade, and that's I guess the primary thing that I do. But I've been testing this last year, and I found that pairing Oris with another strategy that I like to call Iris, just because it's kind of goes along with the whole Oris theme. It's a powerful combination. And I'll explain to you in just a second why. But Iris is essentially a put credit spread, also with a set of rules with it. And I think a lot of you are familiar with put credit spreads, very common type of trade where you are selling a put. This particular strategy is selling a put out of the money, pretty far out of the money, and you are buying another put below that as like a hedge, right? So when you sell that put, I like to think of it as I'm like an insurance company, and I'm agreeing to insure a particular stock below a certain price. So if you're looking for insurance on your 100 shares of stock, you can come to me. I'll sell you the insurance at a price that I'm comfortable with. It's pretty far out of the money, and if it goes below that price, I cover the losses, right?
Right.
But I don't want to cover all the losses, so I'm also buying insurance myself, which I call reinsurance, right? Hence the name insurance, reinsurance, income system. So I buy reinsurance to protect myself, but it's essentially it is a put credit spread, right? Right. And the reason I like to do that is because sometimes there'll be a stock that I'm interested in. I would like to maybe start an Oris position in that stock, but it's a little bit too overpriced. Or I look at it and I say, it's not really trading near support. It's kind of, between support and resistance. I really would feel more comfortable if I started an Oris position down at a support level. And I think I have an example I can show you to kind of solidify that. So just in just 1 second, I think I have a chart in these slides so I can kind of show you what I'm talking about.
Yeah, that would be great. And for people that are new to this type of idea, I know a lot of people do trade spreads, but you putting on your own set of rules and your own take on this. Sounds like you're doing really great. I mean, I think you mentioned that you'd won like 15 in a row over the last month or so.
Yeah, I think it's gone up a little bit, 16, 17 maybe now. So I started recommending these, not recommending, but alerting my my Discord group to these Iris trades starting in November. I think November 7th was the first day I posted one of these. And since then, I do a couple a week, sometimes more. And yeah, it's been, I think, 16 or 17 now that have closed. And so far, I've not had any losers, with one caveat. So I did one on Airbnb, and it looked like it might turn into a loser because the price came down right to my upper strike price, so my short put. And it was like the day before expiration. I was nervous that it might breach that the next day on a Friday. And so I rolled it. right? Which you can do, and actually rolled it for more credit at a lower strike. So that's kind of an interesting thing you can do. And so I think I moved it down from like an 82 put down to a 78 put, and to the next week, or maybe it was 2 weeks from then. And then that closed for full profit. So, but had you held that one more day on that Friday, you would have been fine as well. So, still didn't lose any money, almost lost money, but yeah, that was as close as it's come. Knock on wood, right? I'm sure. Well, you'll inevitably have some losers, right? So I'm not saying this is foolproof. You're going to have losers at some point, but we do everything we can to try and mitigate that risk. And I'll talk about that in a second when I show the chart.
Yeah, no dealing with toilets. I like that one.
Yeah, so my thinking behind this, and this is, maybe for those who are just already trading in the markets or investing in the markets, this won't matter to you so much. But there are a lot of people, and I have a lot of friends who are always looking for a side hustle. Some are doing Airbnb or Turo, like I just mentioned, and it does seem to me like a lot of work. And I feel like it's a comparable investment of, amount of money that you would need. And I feel like using Oris or Iris, you can pretty much make a comparable profit with a lot less headache as doing Airbnb or Turo.
Totally, yeah. And I ran an Airbnb for a while, and it was a nightmare, and it just doesn't produce as much income as you hope it would. So I agree.
Yeah. I mean, I've never done it myself, but just having rented Airbnbs, the amount of time people, the owners like texting back and forth with us on issues and all that. I don't know if it's worth it. And I actually, I think on an earlier webinar that we did in my Discord group, I had shared some stats, and some other time I can share these, where I did some research about kind of average profit from an Airbnb, and it didn't turn out to be as much as I thought it would be, especially when you factor in your time.
Totally,
yeah. So let's skip this, because I think most people know what covered calls are. This is just part of my presentation, because I never know who I'm speaking to and what level of understanding they have. But if you don't know what covered calls are, look it up. But that's kind of the basis of this. And instead of doing a covered call, I do a poor man's covered call. And then here's some stats on kind of rough amounts you collect from selling a 30 DTE covered call. But this slide maybe would be of interest to you. So I guess going back here, if you did a traditional covered call, you would be buying 100 shares of stock. So that would be kind of the capital you would need to put up to do a covered call. And then when you sell an at the money covered call, or an at the money call, let's say it's a 30% implied volatility. So it's maybe your average stock is around 30 to 40% implied volatility. You'd probably collect 3% of the cost of that, of the 100 shares. So if it cost you $10,000 for 100 shares at $100 a share, you'd maybe collect like $300, right? For selling that 30 DTE call.
Right.
Now that's still, it's still a very valid strategy, but kind of the light bulb moment for me was when I discovered, okay, well, instead of buying 100 shares, I could buy a Leaps call for about half or 1/3 of the price. So instead of spending $10,000 in that example, I would spend maybe $3,000 or $4,000 and still collect that same $300 of premium for a 1 month period.
That's a huge motivation for people with smaller accounts or people that don't want to risk as much. I think to be able to do that is pretty good. I like the idea.
Yeah. And for the most part, if you think about it, a lot of the big quality companies, they're unlikely to fall significantly, although 2022 taught us differently. Right. So like once in a decade, you get a 2022 year. Yeah. But even then, if you're paying attention to fundamentals, which is kind of what I preach in my Discord group, is, it is a value-based strategy. So we only want to do this on undervalued stocks. And actually look at the like discounted cash flow models and see, you know, roughly what do we think the stock is worth. And then you only start it on stocks that are trading far below what seems to be fair value. And then you're also looking at technicals. So like you don't want to start this when it's maybe breached a strong support level. Maybe you want to do it when it's at a support level, right? So it kind of mitigates the downside risk in the stocks that we select. And then on top of that, in my mind, it's actually safer to do a poor man's covered call because you have some stocks, for example, PayPal. PayPal was a bad one for me, but I didn't start doing ORIS on PayPal like at the top. Thank goodness, right? I thought it was like pretty cheap when it got down to about $100 a share, and that's when I started doing ORIS on it. It's at, I think, about $80 a share right now. But if you had started when it was like above $200 a share, and the stock came down, you know, to I think it was down at 60 something at its low. If you had shares, you would have lost a ton of money. Like it's like 80%, right? Yeah. But at least when you do a poor man's covered call, you have an automatic stop loss, and that's like going to be 30 or 40%, right? So you kind of automatically hedge your risk there.
That's cool.
Let's skip this because I've explained what a poor man covered call is and ad infinitum, right?
Yeah, you were saying that it's typical returns on the strategy, though.
Oh yeah.
Yeah, it's like 10% monthly, which is pretty amazing when you think about it.
Yeah. So just pointing out the slide. Yeah. So if you do the math, it usually on an initial trade, right? So when you're first starting a new ORIS position, you're typically collecting 8 to 12% of the capital at risk, right? Which is essentially the cost of your LEAPS call. Yeah. And so that's pretty significant return in a 1 month period. And then it just depends where the stock is for your second month. So if you're going to do this a second month or a third month, I'll show you in just a second on the chart. It just kind of depends where the stock is trading at that point in time, what percent you can collect.
Cool.
Let's just flip to this this chart. I thought I could write on my slide. Yeah, I can. Okay.
You can, yeah. It looks good.
Can you see the writing?
Yeah, I saw a red line appear.
Okay. Good. So this is a chart of Google. And so I this is one that I've also initiated an ORIS position in a while ago. And I kind of want to show you, I don't have the exact dates in front of me, but I'll kind of, so this will be somewhat of a hypothetical, but actually has some relevance because it's approximately what I did. But it's probably around here where it looked like, you know, it had some pretty solid support, right?
Yeah,
back here.
Until it's not, right?
Yeah, so it seemed like a good place to start an ORIS position.
Yeah.
And so let's just call it roughly $100 a share there.
Mm-hmm.
And I think Google is typically like a 40% IV stock. So that means I'd collect about 4% of the cost of 100 shares. So 100 shares would be about $10,000. So about $400, right? So I could collect maybe $400 from selling that at the money call. And at the time, you know, I think I probably paid about, let's say I paid $4,000 for the LEAPS call.
Yeah.
Okay. So I'm roughly collecting, you know, this is 10%, right?
Right. Per month. So.
Right. And so that's at this point in time. I probably sold these red dashed vertical lines are option expiration dates.
Right.
If we were doing it like on the monthly, you know, the third Friday of the month or whatever.
Right.
So I probably sold, you know, this October one, right? So back here, I initiated it and selling 1 month out. So it probably was this one that I sold. So time goes by, right? And as a investor in this particular trade, you're like, oh man, this is going down, right? But you're feeling a little bit better because this $400 is just going to decay to zero to keep that $400, right?
Yep.
but you're still probably showing losses here on your overall trade. But it goes back to where you started, right? And so your Leaps call roughly still is worth at this point
About
$4,000.
Yeah, because it's so far out, and
yeah.
you're okay.
Yeah, right. And so then maybe at this point you're selling the next month for another $400, right?
Right. So you've got 800.
And actually, it was like right before earnings, probably.
Yeah.
So you might have collected like 500 there, because the IV was higher.
Right
before earnings, right? And then we go another month, and it really tanks right after earnings, and so you feel like you're stupid. But if you're in quality stocks and you're pretty sure about the valuation, eventually they kind of recover, right? And so when it gets to this point, that you collected that full $500, and then you sell another one for the following month, and it's a little bit below your initial starting price up here, right? And so you probably would sell this for something less. You're still selling the $100 strike, let's say, but this time you're collecting maybe, $250 or something.
Right.
Okay. That's still, compared to your 4,000 that you put in.
Yeah.
That's still a significant percentage, right? I mean, that's over 5%.
Right. Yeah, exactly.
Right. And so this is like 10%. This is what? This is 12%.
Yep. And so you're continually holding this $4,000 Leap calls, and they're really not changing that much in value. I mean, sure, in this chart it's gone down a little bit, but it's probably only, what would you say, 10% down or something on the underlying, Leaps call.
Yeah. So at this point, so like this at this point, right? It's probably, maybe it's like 3,500 or something. Right?
Yeah. But you're pulling in those 400.
But you're pulling those in, and that's just at this point in time.
Right.
If the stock recovers, this could very well go back up to 4,000.
Right.
You're going to have a little bit of time decay, but the time decay is actually not when you're going 85 delta deep.
Right.
It's typically kind of a rule of thumb is the amount of time value on that 1 year Leaps call is maybe about the amount that you collect from your first month. So maybe it was like $400 in time value decay, but it's over a 12-month period, right? So on average, it's like 30 or $40 a month of time decay.
Right. So even if they're going sideways or slightly down, you're still collecting these hundreds and hundreds of dollars a month.
Yeah.
Most likely you're going to see that $4,000 recover. If you're following your strategy, you're most likely going to see that recover within a few months, even if it goes down, right? It seems to be.
Yeah. And here, like even here, right? So at this expiration, let's say we sold another, call. This is at the $90 level. So it's about 10% below where we started.
Yeah.
And another rule of thumb, when you're 10% away, you typically collect about a quarter of the at the money rent. So I would probably collect $100 here.
Yeah.
Right. Which again, as a percentage of the 4,000 is still a decent percent. I think that's over 2%.
Yeah, and so like people that do dividend investing, this is not that different, except you get much higher returns, right? So if you buy a dividend stock and it goes down for a year, you get the dividends, but you're also at an overall loss on the underlying, stock. However, here you're making a lot more per month than you would with the dividend stock, and if you do it properly, you don't end up at a loss, particularly for the Leaps. So,
right. Yeah. So over, you do this for 4 months, right? And you add these all up, right? I think adds up to be like 1,250 in this hypothetical.
Yeah.
Right. Over your 4,000.
Right.
Right. I don't know what percentage that is, but it's 30% or something.
Yeah.
Right. So 30% in 4 months, which is not too bad. And this is actually like a good case, right? I mean, it didn't go drastically down like 80%, right? So as long as that doesn't happen, it actually works out pretty nicely. You just got to be patient. Don't feel too bad when you have these drops like that, and you'll be okay over time if you're in kind of solid, good quality companies.
Yeah. Love it.
Yeah, that's kind of the point of this next slide. But so yeah, you will lose money on some positions. But what I've realized over time is just because that initial month maybe didn't work out and you're showing a loss after the first month, you got to think about these Oris trades, not as single trades, but as a campaign of trades, right? So it's the campaign that matters. I have some stocks like I'm doing this on IMAX, the IMAX movies. So yeah. IMAX is a company. I've been doing this Oris thing on IMAX just for fun to see if I can pay for all my movie tickets with Oris. I love that idea. IMAX position. I think I did a video on it. And so it was like $750 investment to begin with, because it was like a $14 stock. So it's a lot cheaper than Google.
Yeah.
And I collect roughly like $50 a month on average, it seems like, from Oris. And so I've been doing it for 9 months now or so.
Yeah.
Right. So I think I've got like total about $450 profit right now, off of the initial $750 investment. And so it's just kind of cool. Like, I feel like, oh, I'm just paying for my average, movie theater watching with my family every month with this one trade.
With this passive income. Yeah, I love it.
Yeah.
That's good.
Yep.
Yeah, and that's what you can do, set up different streams of income. And this idea to set up for that in particular is really good. Just cancel out your expenses with these Oris trades. I love it.
Yeah, exactly. And I just kind of like the irony of it. Like, I'm doing one on Comcast, right? And I'm like, can I pay for my Comcast bill with,
perfect,
with this? Yeah. And stop me if we get any questions. I mean, if
there's been a few. So Montana Slim just asked. Let me put the question up really quick.
Okay.
I don't want to interrupt your flow too much, but there's some questions. So.
Yeah, that's a good question. Show an example of one where the sold call goes in the money.
Yep.
Yeah. So. I delete. I don't know.
That's looking like quite a crazy chart.
I don't know if there's an easy way to delete all this.
There you go.
I'm using the eraser, but it's got to be a delete all somewhere. I don't know. Yeah. So, and actually, like, right now is where I have that problem, because the market has gone up so much. Virtually all of my positions are in the money. I have my short call is in the money. Right. And so let's just say if we started it here, okay, right? So then we can show kind of what happens. So same thing, we collected, roughly $400, and it cost us $4,000. Yeah, so you are capping your upside, right? That's the trade-off. That's why you're getting paid this premium, because you're selling the upside above this point to somebody else in the market, right? So when the market goes up, you don't really participate, but you still get to collect this rent, right? So you'd still collect that $400. Now, the value of your Leaps call, this $4,000, should go up as the market goes up, right? But this also goes up, so they kind of cancel each other out, right? Although if this was an 85 delta, this will be 100 delta at especially when you're getting closer to expiration, and it's deep in the money. So you are actually, if you look at the profit loss charts of these, they'll kind of be a downward droop. And if this is price, right? So this is maybe the strike you sold, your overall profit kind of decreases slowly as the stock price goes up, just because of the differential in delta.
Right. And I see you posting these charts whenever you give a recommendation. Yeah. I've seen you posting these in the Discord, which is pretty interesting.
Yeah, so I'll post a profit loss diagram. So I'll model the trades in Thinkorswim with their modeling tools, and you get some kind of funky looking kind of profit losses. Like, sometimes we'll put a hedge on it, and that will make it like so your normal trade looks like this. But then if we put a hedge on it, usually it's like a put vertical spread or a put butterfly spread. you get these weird looking profit loss where it's like a zigzag. So it actually puts your stop loss quite a bit lower for not much additional cost. So we kind of talk about those things in the Discord and show them in various trades. I was using that a lot in this 2022 bear market, where it's like I was just hedging every initial Oris trade so that I had a little bit lower of a stop loss. But what happens as it goes up, right? This goes in the money. You can still just roll this. So I could still, at this point, I could still sell the $100 strike call. So what I would do is before expiration, I would sell a new one the next month, and I would buy back this one over here. And at that point, let's see, this is like $120 almost, right?
Mm-hmm.
So this would be worth $2,000, right? Like this would become $2,000. So I'd have to buy it back for $2,000. Now, this probably is now $6,000, right?
Yeah.
So there's some offsetting there. So I would have to buy it back for $2,000, but I could probably sell this down here, and it's going to be deep in the money, right? So let's say I sell it for $2,100. So I'm selling a new one for $2,100, and I'll buy the expiring one for $2,000. So I still net a credit of like $100,
right.
And so that's my premium. So the further away you get from your at the money strike, whether up or down, the less percentage you collect in time value, which is our rent. The rent that we collect is the time value, right? So if you kind of look at the chart and, I'll draw a line here at 110 and I'll draw a line down here at 90. And we're just right in the middle at this $100 mark is where we were selling that strike. We love it when the price stays around where the sold strike, because that's where we'd collect like 10% returns, right? And I know this is getting messy. I'm trying to clean this up.
Now, you're doing a good job explaining this. It's a complex thing, and if people have any questions, just reach out to us on Facebook if you're in the Facebook group. If not, just send us an email. I'll put my email address in and forward it to Stephen.
Yeah, it is a complex topic, and so it's not something that's just like a 2-minute answer, right? It's a more lengthy answer. So if you do join the Discord group, I have people who ping me with questions like through the direct messaging, right? So just a one-on-one question. I can even talk to you on a call. I've done that before, just to kind of explain some of these concepts because they're a little bit hard to grasp initially. But once you got it, I mean, it's actually not that complicated once you kind of have figured out the different rules and how these different call options work.
Yeah.
But yeah, I was just going to say, so you collect 10% right at the money if it so happens that when you're rolling or when you're selling a new call, you're right at the money. But if it's either, deep in the money, maybe by 10%, or out of the money by 10%, you're typically collecting like 2.5% of your capital at risk, right? And then even further out here where you're now like 20% out of the money or in the money, you would collect like 1%. So on a $4,000 investment, you're only collecting like $40. So it may not be worth it once the stock gets too far away from where your original call is, was sold. Yeah. And so that's typically when I'll close these trades. Like if the stock has gone up so much, and I kind of don't feel like it's undervalued anymore. It's kind of a nice thing because it forces you to just cash out and move on to something else.
Right. Totally. Cool.
Yep. So I think I only have a few more slides left. I thought I would just share like the first 3 rules of Oris. I mentioned Oris is essentially a poor man's covered call with a set of rules. There's 10 rules to be exact. So the first 3 I've included in this slide deck. The first one is one that I've developed for myself over time, given the different bear markets I've gone through. like the .com bust, 2008, COVID, and then 2022.
Yeah.
And I always feel like I'm too conservative. Like I kept too much cash on the sides too long.
Yeah.
But it's been okay. It's been okay. It's better to have more cash, in my opinion, than not have enough.
Absolutely, I agree. 100%. Yeah.
So yeah, that's rule number one. And I like to keep 50% of my account in cash at all times. And the fact that you're doing a poor man's covered call, and it requires coincidentally 40 or 50% of the cash you need to do a traditional covered call, you can just keep the rest, what you don't spend in cash, just in case you need it in a market downturn. The second rule is position size matters. So you don't want to put, all of your portfolio into one or two positions, right? You want to diversify a bit. And so I have some rules around how much of your investable cash, right? If you're keeping 50% in cash, then that means you have 50% that you're investing. Of that investable cash, I don't like to put more than 10% in any one position. If you have a larger account, I'd make it maybe even smaller. And if you have a smaller account, maybe less than $10,000, you're probably kind of forced to put more than 10% into each position, just to make the returns still meaningful. So those are kind of my rules there. Any questions? Do you have any questions?
No, everybody's been pretty quiet. So the last one was from Montana Slim about the example of when things go wrong. So it's always a common question we get, I think, is that's great, but what if the worst case scenario happens? Are you going to destroy your entire account? It's always right. I get this on all of these types of styles of trading. So
yeah. The third rule is stay diversified. So these are kind of things that might seem like common sense, but it's, without reminders, sometimes we do crazy things with our portfolios. So I like to try and stay diversified. So when I'm looking for new opportunities, I'll kind of say, when I'm kind of going through a checklist in my head, one of the check boxes is, okay, which sector am I lightest in, right? Maybe I need more exposure in one sector or less exposure. And so recently, for example, I've noticed I don't have very many healthcare stocks right now in my portfolio. I'm not running Oris on very many healthcare stocks. So I'll do it. I'll look specifically for healthcare names and kind of start screening there.
Mm-hmm.
So that you have a nice balanced portfolio. If you looked at the market in 2022, right, certain sectors, if you look at it on a sector by sector basis, I mean, do you know what the number one sector was last year?
Not off the top of my head, no, but it wasn't technology.
Nope. It was energy. Energy was up 60%.
Wow.
Right. Okay. So if you were in energy, you had a great year.
That makes sense. That makes sense. I mean, I know Matt's oil stuff did really well last year. So.
Oh, yeah. Makes sense. So energy was the number one sector, and the leadership changes every year, right? And you never really know which sector is going to lead. But the worst, were like communication services and technology. Surprise, surprise. Those are the worst. So the average, the S&P 500 was only down. It's still a lot, roughly 20% last year.
Yep.
But it was helped a lot by all the energy stocks in the S&P 500. Otherwise, that's why tech was down. I mean, the NASDAQ was down 35% because it's more tech heavy, right?
Yeah.
So diversify. It's the only free lunch. And I think that's, is that it? No. Oh, here's my, I have three more slides. So, so the Synthetic Yields Investing Club is kind of what I call my Discord. What you get if you join, right, is trade ideas. So I'll typically post around one, sometimes more than one, but usually at least one Oris trade idea per week, and then 2 Iris trade ideas. And the Iris trade ideas are kind of more frequent. I kind of think of that as like, kind of like, I don't know if you follow NBA basketball, anybody out there, but like each team has like a G League team, right? Like a farm team that players who maybe are not quite ready for prime time, will play in the G League, right? And so I kind of view my Iris trades as like trades that are not quite exactly where I'd like to start running Oris.
Right.
I'd like them to be a little bit lower. So I'll do one of those put credit spreads at the price. And if it gets down to that price, then great. I can start Oris at a cheaper, better price, right? So there's typically 2 of those a week. You also get access to, we have an app. So create an app for helping you find setups really for Oris and Iris. It just helps you find undervalued stocks, kind of is narrowing it to the universe of stocks with weekly options. So that way you have options you could sell every week. You also get coaching. So you can ask me questions in the Discord, in one of our group channels, the questions channel, for example. You could ask questions there, or you can DM me as well. A lot of people do that. Case studies, I'll post every once in a while. Case studies, for example, I did that video on IMAX, and kind of you can see in real life how, over a multi-month period, this is how much I collected in the first month, the second month, and the stock went down, and this is what happened, or it went up, and this is what I did. So I have some case studies. And then online course, we do have an online course that you get access to, and they're pre-recorded videos there. Some of it's just text based, and then we've done some live videos before.
Cool, yeah. So it's fantastic, and honestly, this app, right? So Stephen's showed me the app, and it's amazing. If you think of something like PowerX from Marcus Heitkotter from Rockwell Trading, this thing is as good as that, but you don't have to pay $1,500 or $2,000 like he wants for his. And so, like, this alone would be a product by itself, but you're getting it in terms, you get access to it with the Discord, which is amazing, right? We've talked about maybe doing it as a different product, but at the moment, you're getting access to it, which is awesome. So I don't know what we want to talk about at this point. I mean, Brian's asking, do you offer a monthly trial or a monthly rate? I think you did decide to do monthly, right? We were originally selling for a yearly fee, but I think we decided to do a monthly, right? I'm not sure what you actually finalized.
Right. Yeah, we moved away from the monthly, and then we're kind of bringing it back because we thought, hey, if people want to try it, we can have a monthly. We think you'll like it, so we're thinking, people will stay. So we're doing a special right now. I think if you look at our website, so the website is syntheticyields.com.
I'll post it into the chat for people to join now. So this is his website, syntheticyields.com. It's a really well done website, very professionally done. So I like what you've done with that website.
Thanks.
It's good.
I can't take all the credit. I use a platform, Podia. It's a common platform, right? So they help you make a nice, snazzy website. But it's $75 per month. But for people listening to this webinar, right, we have a coupon code. So when you go to the checkout there, you should be a place where you could enter a coupon code, and we're doing the coupon code is 25 off. I don't know if I can write on my screen. I'll write on.
I'm writing it out now too in the chat. So 20 off.
25 off.
Right.
So that should give you $25 off forever. I mean, it's not just the initial month, it's just ongoing. So it'd be basically $50 a month.
That's pretty good. That's pretty good. I'm liking that. Yeah, that's great. So
so $50 per month. We do also have, some people prefer just doing an annual. And so the annual cost is normally $750 per year. And so we have another coupon that's $250. It's kind of hard to, this is a 0. This is an O. I guess I should have created different coupon codes, but this is an O up here too.
So for the yearly, it's $250
off. So that makes it it'll take it down from $750 to $500 for the year.
So 250 and then off. I'm just putting it into the chat as well. It looks better on the typing keyboard. You can tell that the 0 is different from
Okay,
the
yeah.
so,
Nobody can even read my handwriting, so I can't.
So there's a question from David here. Any thoughts on using weekly short options for the ORS trades?
Oh, sorry. Was that a question?
Yeah, it's up on the screen now. If you can
Oh,
see it by David.
sorry. I think okay, there we go. I didn't have the other screen up. Yeah, so you can. It's always a balance. Like, if you go longer duration, you collect more premium, but you collect less premium than you would if you did, for example, four separate weekly ones. And that's if the stock stayed right at the money that whole time, right? Like if the stock stayed right there and you can guarantee it, you definitely would collect more selling every week. Problem is you just can't predict exactly where the stock's going to move, right? And so if you kind of want to lock in a higher amount, for example, on that Google one, right? You might be able to collect 150 per week, probably. Or you can do 400 for 30-day, right? So you can guarantee yourself the 400, or you can take a risk and do 150 a week and just see where the stock's trading at the end of each week. If it goes up a lot or down a lot and you still want to sell that same strike, then you might collect less, right? So it's a gamble. Sometimes what I'll do though is I even have a couple right now where earnings are next week.
Yeah.
And so, like the expiration was just last week or this Friday. I have some expire this Friday, but they're announcing earnings next week. And so, sometimes the premium is really high. And so I'll just sell like 1 week out or 2 weeks out because I'm getting still quite a bit of premium off of a 2 week or a 1 week. And it's like 60 or 70% of what I would get if I sold the 30 DTE, 30 days out.
Right.
So it just kind of depends. Your preference. It depends on what you kind of think the stock will do.
Yeah. Very cool. So, shall we show them the website and talk a little bit about what, I don't know if you can put up or if you want me to put up. Could are you able to
No, I can. I can pull it up. You will be seeing the version that is for me, my admin version. So I have some things I'm testing in here that, if it looks a little bit wonky, but I'll show you.
Yeah, and for you guys listening, I've been through the website and I've been on the Discord with Stephen for a while, and there's a lot of amazing due diligence that he does. Like the posts are very extensive, really saves you a lot of time and effort to find these things, which is really good.
Yeah. No, and we try to. I'm trying to make. I actually build the tools for myself. I would do this even if I didn't have a group because this app came about because I wanted a tool for myself to find these trades easier.
Yeah.
And so I built it and I was like, might as share this with everybody. So, and I'm actually not used to the website because I use it on my phone. So if you use it on your phone, it looks more like a mobile app.
Right.
It would look like I don't know if I have. I don't know. There's a way to show you a mobile view, but essentially it looks like an app. It's pretty cool, and you can actually save it to your home screen. So even though it's a web app, you can make it look like a native app, and then you can access it easily from your home screen right away, and it open up like an actual app. So it doesn't look like it's even in a web browser at that point. And that's my preferred way to use it. I like to use it on my phone. So I'm not even used to the web, the web look of it. Right. But essentially, we've got a bunch of filters here. You can hide those. So this first tab, this ORS watch list, I kind of preset certain filters on it. So the total global, the global, what do I call it? The total number of stocks that this app kind of tracks is 614. These are 614 stocks with weekly options. Mm-hmm. Okay. And then from that, this Iris tab has whittled it down to about 74, depending on certain criteria. For example, it's only showing you stocks that are estimated to be have 20% upside. based on fair value, right? That's one criteria. I think it's over 2 billion market cap is another criteria. So it's doing some things in the back end to filter down the list even further. But you can use these filters as well. Like, let's say you had a small account and you wanted to find stocks that are less than $20, right? Yeah. You could apply that filter, and then now it's showing you 7. And I call them rental properties, going along with the whole theme of, you know, kind of like you're renting out your stocks. So you can easily filter that way. Let's clear the filters for now. But you can see like Google, since we are on the topic of Google, we might as well stick with it, or Alphabet.
Yep.
So you just show you a chart, and if you click it, it should switch to like a weekly chart. So if you want to kind of zoom out, you can see the multi-year view. And then we got some valuation stuff here, the current price versus fair value estimate, right? And there's 22% upside according to this. I mean, values are range, so like it's not like this is the exact value, but it's roughly based on some calculations and some statistics. It's a good estimate of fair value. Analyst target, those sort of things. Some of this down here is me messing around. It's not in the live version. But down here is where it's cool. At least I think it's cool. Where cool, yeah. You can see some of the Oris stats, right? So if I wanted to run Oris on Google, maybe my estimates were a little off. So the implied volatility, I think it's probably higher because they're about to announce earnings, right? Mm-hmm. And so it's estimating that you could collect about $550 of rent from a 30 DTE.
Yeah.
And your leaps cost is in a range of, you know, 4,000 to 5,500. And so it's estimating your return for that 1 month would be 10 to 14%, right? Yeah. Essentially.
And this is what's so cool. You guys get access to this as well as the Discord and the due diligence that you're doing. But you can also use this to figure out what else you might want to do, right?
Yeah. Like like I said, I post a few trade ideas every week, but yeah, I understand people might want to go their own way and find their own ideas, and I welcome that. And so this helps you to find your own ideas, right? And your portfolio is going to be different than my portfolio, so you might need something in the energy sector or something that you're looking for, right? And maybe I'm not posting it that week because I've already got my fill of that sector in my portfolio. So yeah, there's a cool button. We're still doing some work on this it's not every stock. It's not working for every stock, but a lot of the big ones it will. You can open an option strat by clicking that button, and it'll just show you. I don't know if you're familiar with option strat, but it'll show you kind of like a profit loss diagram, and you can actually see the actual cost of the call. So here we're doing an estimate based on some implied volatility and stuff. So it's a rough estimate. If you want the exact amount, you can open option strat.
Cool.
This here, by the way, is, I was talking about when it's 10% out of the money or in the money, you're going to collect less, right? Instead of collecting 10 to 14%, it's estimated you collect 2 to 3.4%. Mm-hmm. It's 10% out of the money. And if it was 20% out of the money, you'd only collect like 1 to 1.5% return, which is like $61, right? And then here's some other just useful stats for evaluating a company. We won't go into each of these, but I like to look at these, just see what like the free cash flow yield is, earnings yield, that sort of a thing. And the next earnings date looks like it's coming up next week. I like to invest in companies that are actually buying back shares. So I like this metric here. It's like they bought back 3% of their shares over the last 12 months. Nice little description of the company. And then here's also, are you seeing my antivirus thing on my screen?
Yeah, it popped up there. So.
I'm not protected, apparently.
Nope. Doomed.
Yep. but I like these links down here. So if you wanted to do further research on the stock, and I just built this for myself because I was sick of like having to open my Seeking Alpha app, typing in Google. So you could just click this button and then it would open up Seeking Alpha for Alphabet. And then you could like look at different articles people have written about it, what people are saying about it, the news, that sort of thing. So I have done it for like YouTube because sometimes I like want to see, some of the YouTubers, the FinTubers out there. Have they done a video on this stock? What are they saying? And then you can just click that and it will automatically populate YouTube with the, search for Goog stock, right?
Yeah.
Things like that. So any questions?
So far, nothing. This is your chance, guys, to ask some more questions. I know it's Friday night and it's getting a bit late, especially if you're on the East Coast. So we'll probably wrap up pretty soon, I think. But let us know now if you have any questions so that we can address them in plenty of time. But yeah, I mean, this is cool. Like, this is more of a sort of like cross between what people like Lance do and then like fundamental investing and kind of a Warren Buffett type approach. And I really like it. I think it's awesome. I think it's a great way to make some extra money, especially if the market doesn't tank all year again, which would be really nice, right?
Yeah, for sure. I mean, it's a more conservative strategy, right? Yeah. So for those who are looking for like the day trades, like the lotto trades and stuff, that's not what this Discord's about. It's more about, for those people who are fans of Warren Buffett and Charlie Munger and like the whole value investing thing and buying things less than fair value and all that. That's more what this group is about. And it's kind of more about a longer term focus and just building your portfolio and building wealth over time, right?
Yeah, definitely. Which, fantastic. And should we give them a sneak peek at the Discord, or are we not set up really to show that at the moment?
Yeah, maybe. I think we can show it.
Yeah, there you go. I can see that. Synthetic yields. There we go. So you have a bunch of channels like normal. There's not too many.
Yeah, so I've got my trade related channels here. So I've got, Iris trade ideas. So typically, this is what it'll look like. Pfizer, we did one on the 19th of January. I'll post, some, which call and which leaps call I'm buying and which one I'm selling and the total cost and all that. And like, annualizes it to 126% annualized return, that sort of thing. And I'll usually have like a little bit of a description of why I think this is a good idea and show like the profit loss diagram as mentioned, right? So you can kind of see if the stock goes up, this is, maybe how much you would get in profit. If it went down, where's the break even, that sort of thing. And I also provide updates, right? At least like kind of like the first month update of, we did this trade on StoneCo last month. It's up $52 off of like the $500 it costs. So it's like a 10% profit in that 30-day period, right?
Yeah.
And then here's the Iris trade ideas. So I'll do a similar write-up here of, here's some Iris trades I just took. And then the updates have an update, right? So you can see we closed quite a few last Friday on the 20th. Had like 4 that closed. All of them closed successfully at the max profit.
Perfect.
And typically those Iris trades, by the way, are typically like, if it's a $5 wide, you're getting $50. So it's like a 10% return.
Yeah.
So like, you can see 13.6, 17.6% return, 8.6, 10%. Yeah. Knock on wood. Iris has been going well so far.
Yeah, it definitely sounds like it has. Yeah, and we haven't really talked that much about the Iris stuff because the focus has always been on Oris, right?
Yeah, definitely. And so, I mean, if you have questions about Iris and how that works with Oris, I'm happy to answer it. I mean, we may not have gone into a ton of detail there, but the idea is it's similar to, if you're familiar with the wheel strategy, it's basically like we're doing a wheel type thing, but we're we're doing it a little bit more conservatively and with less money, but less total capital at risk.
Yeah, and so I'm posting a link to the Facebook group so people can come in and talk to you in there about it a little bit more. And then you guys have my email address. I'll put it in here one more time. So if you want to email me to get in contact with Steve about any of this stuff, then just let me know. So Stock Alerts Reviewed at protonmail.com. Just putting that into the chat too. So yeah, fantastic. Great. So I love the strategy. I think it works really well, especially in this, hopefully this new bull market will be awesome. Any questions, guys? Because if not, we're probably going to wrap up and go and enjoy the rest of Friday night and have a good weekend and just try and chill. But yeah, reach out if you have any more questions, especially if you're watching this after this live is finished. I'll make sure the description has all the details you need to come and check out the Synthetic Yields Discord and or get in touch with Stephen or myself. So be pretty good.
Well, great. Thanks, Russell. Appreciate it.
Yeah, no problem. And I think it looks like there's no questions, so I'll give it another like 30 seconds and then move on. So it'll be pretty good. So yeah, okay. Well, no more questions. So let's wrap it up and hope you guys have a good weekend. And then we can go from there. So sounds good. Well, thank you very much for your time. It's been good.
Yeah, thank you.
All right, cool. Have a good night, guys.